What is DCA or dollar cost averaging? I will share with you two DCA strategies that you can start using today. First is the traditional or pure DCA. The second method is called Martingale DCA. So what is DCA? DCA is basically investing a fixed amount on regular intervals. What does this mean? First you determine the fixed amount, maybe $100, then you determine the regular intervals, maybe end of the month. So basically you will put $100 at the end of the month into the market regardless of what the price is, and this is pure DCA. The key benefits of doing DCA, of course, is that it reduces emotions and market timing problem. Why? Because you have already determined what you will do. You will invest $100 at the end of each month. So there is no active decision that you need to make. That is why no emotion is involved. And also you're not planning to time the market because you have already determined at the end of each month you will put $100. So this is how it helps you. Second benefit is it keeps you invested into the market without the need of specific or detailed analysis. You are just investing at regular intervals and trying to make a good average price. But on the other hand, of course, no strategy is risk free. So key disadvantages of doing DCA is you might still be buying into the market when actually it might be time that you should not be buying in the market. Maybe fundamentals are not good or recession is coming or whatever reason, but due to DCA you're still buying. Second, this strategy does not eliminate risk of investments. You can still have loss. So keep that in mind. Now let's take a look at the two ways you can implement DCA strategy into your portfolio. First is the traditional or pure DCA. The second method is called Martingale DCA. Let's take a look at traditional DCA. When the price is increasing, so you're putting $100 every month. You can see prices increasing by roughly 5% each month. This is the quantity you're able to buy, and then here is your DCA price. At the end of month 10, you will end up with an average price of 123.34. Given that last price is 155.13, this means your DCA profit will be 26%. But the key thing to note over here is imagine if you would have put $1,000 at the start of month 1 at 100 price. Today you would have $550 as profit or 55% profit. So yeah, DCA is reducing your profit. Now let's take a look at the opposite situation when price is going down by 5% each time. While doing this, you end up by having an average price of 78.53 against the current price of 63, which means you will face a DCA loss of 20%. But imagine if you would have put $1,000 at month 1, today you would have been 37% down. So yeah, DCA is preventing you from having a higher loss. So this is one of the benefits of doing traditional DCA. Now we will look at Martingale DCA, and this is generally being used when price is decreasing. The main difference is that with each drop in price, you increase your investment amount. We started from 62.75 when the price was 100. We end up investing 147 when the price is 63. So we are still investing the same $1,000, but this time our average price is 75.5 versus the current price of 63, giving us a loss of 17%. Again, if we would have invested $1,000 at the start of month 1, today we would have been 37% down. So you can see the benefit of Martingale strategy, that you're able to take benefit of declining prices. Similarly, what will happen if you do Martingale when price is increasing? Although this is not used a lot, but let's see. So investment is increasing as price is increasing. We come up with an average price of 128.12 versus current price of 155. Which gives us a current profit of 21%. If we would have invested $1,000 at the start of month 1, we would have been 55% in profit. So to summarize, we can see traditional DCA when price was increasing gave us 26% profit and 20% loss, whereas Martingale was giving us 21% profit and 17% loss. Now that you understand both the methods, you can apply them as per your situation. But once again, remember that no trading strategy is risk-free. As you can see, we saw losses in DCA also. If you like this video, please don't forget to subscribe. Thank you.